And in three, two, one. Hello, and welcome to another episode of Guide to the Grind. My name, as always, is Jeff Eady. It has not changed. Joining me today is one of Canada's favorite mortgage brokers, one of my best friends, and the full moon to my fever, Mr. Jonathan Tilger. Jonathan, how are you today?
Oh, I am well, we're just past the full moon actually by the day right now, so I think we missed that one just a touch, but I am doing absolutely phenomenal. How about yourself?
Well, I'm doing pretty good. I try to make it somewhat relevant to what's going on in my world right now, and I couldn't think of anything to go with doing my first cattle drive yesterday. So for you listeners out there, if you're listening to this for the first time, welcome. If you're not, please give us a share, a like, a comment. These things really help to get the messages out here or out there. And if you like what we're doing, you want to know more, you can always go to guidetothegrind.com where we cover money, mindset, and momentum. I am super excited to introduce our guest today. He is a 40-year plus professional investment manager and registered investment advisor whose current adventure is coaching both individuals and other advisors in creating income independence for themselves and their clients. He's also promoting his second book, Retirement Money Secrets. He was a private investment manager for 44 years, personally managing around 325 individual portfolios in the US and abroad. One of the very few investment book authors who have directly managed other people's money. That's awesome. I love when people do what they say. His approach will allow folks to say neither a stock market correction nor rising interest rates will have a negative impact on portfolio income. In fact, either condition. You know what? Please welcome to the show, Steve Selengut. Steve, welcome to the show.
You almost got to the end of that.
Got lost on that last line, but so be it. It is what it is.
Yeah.
We're just having fun here. So, Steve, we got started just a little bit before we came on here talking about how you got into your world of the investment or your space within the investment world. Do you want to fill folks in on where you come from and how you got started?
Well, I come from North Jersey. Um, my dad was a real estate developer and builder in the Lake Apacong area in Northwest Jersey, and I could have gone there, I guess, when I was in college and thinking about what you're going to do, and I, I wasn't really, I didn't make many decisions at that stage of my life, other than what was going on at the fraternity house. So I really I went away to, I got through college. I got a job in New York and I commuted there. And towards the end of that, I got a great position in the pension investment department of a big company. So I started traveling the country, talking with investment managers, um, figuring out what they were doing and how they made the decisions on what was in their defined contribution plans
Mhm.
that we employees dealt with and that I was not selling, but talking to their clients about to change the record keeping system. So I used I used their selection process, the quality part of it, the diversification part of it to manage my own portfolio. I was fortunate enough to choose my parents well, and I had some money of my own to manage. And my goal was never to lose any of it. And one of the features that I applied was, in addition to what my company did, was not only did I only look at quality and diversify properly, but I also insisted on having income from everything I invested in. So I stayed away. I mean, if you think about it, over the years, that kept you out of the dot-com bubble mess because
Mhm.
most of the NASDAQ companies didn't pay any dividends. So I wouldn't have owned any of those for myself or my clients and things like that. So it was a way of going about investing that in some ways was similar to the rental properties that my father had, you know, because if he could sell them, yeah, he might. But the important thing about them was that the rents keep coming in every month. And that was what he used to finance going out and buying a piece of property to develop and stuff
So
like that. But
so
he
you've
always
made
knew, he always knew that the money was there for his wife, my mother, to go out and do whatever she wanted to do with it. So, so I, so there's a similarity between what I do now and what he did then. So That's the background. I
So
managed over $100 million, and not in one big fund or a model or anything like that, but separate portfolios. So it was a very time-consuming effort. But for the most part, all of my clients or when I sold the business last year, they were all income independent at the time, which means they had more than enough money to pay their bills and reinvest the difference.
I find that all really interesting because when we spoke before we got on here, you spoke about how your father was in real estate development and you looked at kind of what he was doing and well, you sort of said, well, that side of it is not for you. You took what you learned, you took kind of the strengths of that business, which is really the cash flow, and you said, how can you apply that in these other areas that you're doing? Which, as you say, a lot of people when they look at investing, they're investing more for the short term. How do I get a quick gain as opposed to how do I build a cash flow off this?
Right, exactly. There's
Now,
very little
what's
emphasis on income.
yeah, what's the process you go to as far as selecting? How do you find the cash flow in? Might as well just dive right into. How do you find the cash flow with what you're doing?
In the old days, when I first started, it was all individual stocks because there wasn't there. Think about back in '79 when I started, there were no ETFs at all.
Hmm.
Mutual funds were really just getting popular. They weren't really a big deal yet, but they were getting there. There the We had a pension plan and we had a defined contribution plan at work, but we couldn't self-direct anything. I mean, you didn't you divided it between equity and fixed income, believe it or not. That's what the choices were for me. And you didn't have any say of what securities were purchased, unlike a 401k today, where most people get their start in investing. And I'm not sure I'm answering your question.
No, no, that
Sorry.
that
You got to realize, guys, I'm 78 and I sometimes lose my train of thought. But
You're
so
actually
so
answering
what
my
was
question
so
that I
get
haven't
me
asked yet.
get me back on track, please.
so what was your? I mean, you spoke about how it started with initially. It's you were just choosing between either your equities or basically your equities or your fixed
Income.
basically you're choosing between those two. How did it evolve into and how did your process change from going from that process to now let's really start investing into things that actually pay a cash flow and generate a cash flow?
Right. So the basic, like back where I was, the basis was everything that I owned paid a dividend. Everything I owned was for sale all the time if I could get a reasonable profit. So the income thrust was in there all the time. It was individual dividend stocks from the start. And then about 15, 18 years ago, um, the things I used to use a system where if a good quality company, let's use IBM or Exxon, any of the blue chip Dow type stocks, if they were down as much as 20%, that's when I would consider buying them. As soon as I could make 10% on the other side, I'd sell it and get whatever dividends I could. So that was the process on the equity side. Portfolios, in my mind, need to be split between equity and fixed income, the asset allocation model. So on the income side, I was using things like I first was using individual bonds and stuff like that, but that's an expensive proposition and tough for most investors to start. And then I started on Ginnie Mae funds, not really funds. Ginnie Mae are a structure and bond trusts, and they paid back principal and interest, and they were good for cash flow and so on for the portfolios. But then I discovered closed-end funds on the income side, and all of a sudden I could buy and sell bonds on it in during the day individually. I didn't have to ask a broker to get me a bid and an ask and pay his markup, on bonds like they do. And I didn't have to do any of that. I could trade them like stocks. So I could own preferred stocks, I could own bonds, I could own mortgages, I could own real estate, all through these closed-end fund vehicles, which really have been around longer than mutual funds. They were introduced in this country in the early-ish or mid 1800s, before mutual funds were about 20, 30 years after them. And ETFs, of course, are the century behind these. And the really wonderful thing about them, if you compare them with today's securities, they own exactly the same securities as you would buy if you're buying an equity mutual fund or an equity ETF and or a mutual fund. There's the same securities. The difference is that they're in a trust vehicle, and it's called a pass-through trust. So they don't pay any taxes on the income they receive or the income they make because they pass 95% of their income through to their shareholders. Now, can you imagine if Amazon passed 95% of its income onto its shareholders?
Hmm.
Wouldn't that be neat? That's what these things do. And they own Amazon and they own Microsoft and Google and all the hot numbers that you can think of. Anything anybody you listen to a spiel or you listen to one of the guys on TV and they talk about this stock and this stock and that stock and that stock. You buy an equity closed-end fund that owns 300 stocks inside. They're in there, man, and they're in there. And when these guys trade them, when these guys collect the dividends, 95% of it comes back to you. And most often on a monthly basis, like 75% of the equity closed-end funds pay out on a monthly basis, and the other ones quarterly. A very few, I call them much more speculative, or pay semi-annual and annually, and I like to stay away from them except for very large portfolios that can afford to wait to see how good was the market this year. If they made a lot of profits, you get a huge year-end dividend. But if they didn't, you get peanuts and you've had it. So for a small portfolio, you don't want to do that because you need the income. So that gives you an idea that the type of security I use to mirror what's going on in both markets, the equity market and the fixed income market, in a vehicle that pays out twice the income.
I always find it fascinating to learn about different strategies within the market because it really is mind-blowing when you first look at it to say, well, how am I going to start investing?
Yeah.
And I mean, thank goodness that people like you exist where you can actually go and get advice. But I think you have a really unique view on investing because of the length of time you've been doing it. I mean, I'm 45 years old. I know what I've seen in my time, but I wasn't in the market. I didn't know anything about investing until, a decade and a bit ago.
Mm-hmm.
But you came through the go-go 80s. You saw the Black Monday. You saw the recession of the 90s. You saw the dot-com bubble. You saw 2000. And most people remember 2008. Can you tell us a little bit about what you saw like in that go-go 80s time and then the disillusionment of investors that happened on Black Monday?
When you say Black Monday, you mean October 19th?
Yeah, I think I'm saying
October
the right
19th. You're talking about 87?
Yeah, I think I'm saying the right expression there.
Okay. Well,
there was of course the big one back in the 20s.
Crash of 87.
Yes. Let's stay there.
if you think about it, just one aside on the crash of 87. If you think about it, they had just in the old days where they never traded 1 million shares in a day on the stock market way back, when I started. But all of a sudden we started to trade in the multi-millions every day because the computers were doing a lot of the trading. Mm-hmm. And they had it was really a new technology at that time. And I couldn't really come up at the time with a reason why we had that particular crash. But after it wound down, I kind of plugged back into my head that this thing was just a giant computer loop where the sell signal kept building and building. Like if you put in puts on a thing, I don't use them, but the same type of principle. It gets to a certain price, you sell. So that's the type of a computer loop. But anyway, the market had been up since the very beginning of the year. And in August, it started to get weaker in August that year. And of course, my premise is at that time, I was selling anything where I had 10% profit. And was putting it back to work when I could find something down 20%. So if you look at how high it had gone, there wasn't a whole lot to put the money back into. In those days, there really weren't even any money market funds yet, I don't believe. So when you had cash, you just had cash. So you kind of were feeling kind of stupid and you're kind of feeling anxious. Why you had to fight back that urge to just dump the money back in there again, because you knew you had these rules or guidelines for you buy lower, and you sell higher. You're not looking for peaks. You're not looking at the bottom. You're not trying to time the market. You just have these kind of rules. And during 87, the good companies, the B plus and better S&P companies, just weren't going down anymore. So there weren't that many to buy. So I started to move more, not because I was timing the market, but I just couldn't sit in stocks. I went a little bit more into fixed income during that time. But starting in August, the market started to go down, and we saw all these great companies, and we start nibbling as they went down. By the time we got to October 19th, my brother's birthday, by the way, so I always mention that to him every time I see him, that it was you that it was your fault. So by that time, when that happened, my broker and I mean, we were throwing money at the stock market. We were saying, "Oh, Pepsi's down, what, 4 points? Put it in another 4 point. Put in an order at X, $2-3 below what the bids are." And we were picking up all these wonderful companies at much cheaper prices for our clients. And within a year and a half, we'd probably turn them over about 2 or 3 times. So the crash of 87, to my model of investing, was a benefit. There's 6 principles of investing that I really outline and focus on in the book. And it applies not only to old guys like me, but applies to your age group and even people younger than you, people who start out and they've got that first really good job and they get that first year-end bonus, and a lot of people in the old days when we first had IRAs and you could put as much as $1,500 away and deduct it, they take that $1,500, they call a broker and they say, "What's hot? Put my $1,500 in that one." I took on clients whose IRAs, they'd been investing their little bit of money every year for 5 years in their IRA, and it still had about $1,400 in it because they lost money on every one of their selections. So the first rule of investing is quality, what you buy. The second rule is diversification, spread it around. The third thing is, and this one's pretty much mine, and these are what I call the 4 great risk minimizers. Because think about what I'm saying. You'll see the more you do these things, the less risky your portfolio is as a whole. The next one is income generation. And my 4th one is profit taking. And that's one of the big mistakes people make. When they do go up, when the market's up, you hear people talking about how much they just made on this stock or that stock. And then 6 months later, you hear them crying about how much they just lost on that very same stock and that very same stock. They didn't take their profits. So those 4 things, and then the 2 others. One is I think a general rule for all investors is to understand that there's really a market cycle out there. You look back, get a historical chart of interest rates, get a historical chart of any of the averages you like to look at, S&P or the Dow. I didn't say NASDAQ for a reason, because it's really almost a sector fund, almost, you could think. And the other ones now contain, initially the Dow didn't own a NASDAQ stock for years and years and years. It didn't. And the S&P got into it a little more so than the Dow, and then now the Dow owns them, of course. So the thing that you got to look at that cycle, and you don't have to know or try to predict anything. You just have to pretty much know where you are right now if you look at a cycle and you're here and all the rest of the things down below, you know you're at the higher point of a cycle. If you're down here, like we were up until 4 months ago, we'd say, okay, now you're in the lower part of a cycle. So you have to adjust your buying and selling parameters by where you are in the cycle. So getting respect for the cycle. There is a cycle. It's never going to just go up. It's never going to just stay down. You don't know. We don't know when or where. And no matter who tells you what they think is going to happen tomorrow, they have no clue. Unless they have inside information and they know there's going to be this announcement being made, they don't really know what's going to happen. And the last one, and if the last general principle is, what are you, know what your focus is. Know what your focus is. Like I know, and in my book, I spell it out. My focus is I want to grow my income every quarter, and I want to grow my working capital every quarter. And that's what I tell people. That's what you look at. You don't worry about the market value because you've done all those other good things, the QDI. You've done those things. You don't have to worry as much. And you're using these diversified portfolios as well. Worry about getting your opportunities to add to positions that are down and sell the positions that go up. And that's makes investing pretty easy. Strenuous. It takes a lot of time and effort, but you don't lose very often. You don't have losers that way, this way.
Have you seen a lot of fads come and go?
Oh geez. Oh yeah. Sure. There are, well, look what happened with cryptocurrency and how many billions of dollars people have I'm not gonna use bad language, have thrown away.
You can use language.
I know. I listened to that one podcast back in October where the guy, what was he? He was talking about the first 2 letters of fun or something like that, you know?
Yeah.
that was really funny.
Brown, after that would have been.
Yeah. I'm not nearly as big an operator as he is. I mean, he has some really impressive credentials, right?
Oh yeah. Yeah. No,
Wow.
absolutely.
Wow. So, and mine aren't nearly that impressive. I've managed to make people comfortable. I've created millionaires for sure, but not multimillionaires. I would say maybe one multimillionaire or two, but 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 what I have done is people haven't had. You've heard the who was it that said, "Thou shalt never invade thy principle"? It was one of the old, I don't know, some writer of one of the great books in the past said that. I don't know if he was an economist or just an investor or what, but anyway, that's a good thing to go by. You don't want to spend in any business, really. You don't want to spend more than you make, right? You can't do that for long. Eventually, you go out of business that way. So the same thing about your investment portfolio. In the book, I describe it as it's your department store. You got stuff on your shelves. You've got lawnmowers. You got a company that sells lawnmowers. You got this, you got automotive products, you got home products, all these things in your store. And if some customer comes in, he wants to pay you your markup, you sell it to him. You don't say, nah, I'm waiting for the price to go up tomorrow. You sell it to him and you put something else on your shelves. That's how you run your portfolio.
I'm sorry, I've never heard it explained that way. You just kind of blew my mind with how simple you just made investing. That's insane. And I mean, I guess that comes from experience, because we've had guys on here who read charts, and we have guys who are like extremely technical and analytical about the way that they approach their investments. And that right there, you're just selling for the markup.
Right. That's
because it is a market.
Mm-hmm.
That's amazing.
It's a market. It's a stock market. It's a market. Right.
Wow.
So
sorry, that just blows my mind.
Well, hey,
I love simplification because I'm not.
So we're done
bright.
here. I got you. Gave you something you needed.
All right, folks.
But you can take it. But let's take it one step. Let's take it one step further. And if you look at those closed-end funds I was talking about, you know, those are, they are the same, they are portfolios within your portfolio.
Mm-hmm.
So instead of the way it used to be when I used to own 55 different blue chip, not blue chip, but B plus or better rated companies that paid dividends, and I had to look at them all. That was a nice department store.
Mm-hmm.
But now I have a portfolio with 100 department stores. I've got a shopping center. I've got an economy, is what I've got. I'm a reflection. My market value is a reflection of what's going on in the economy around us, in the world economy. That's what it boils down to.
How'd you figure out which of those closed-end funds were actually worth your time?
There's and again, I'll keep referring to the book, but you go through these 4 steps and you look, there's a website out there that I use for my research called CEF Connect. I have no connection to it. It's Nuveen. You've heard of Nuveen, the company Nuveen? They are one of the bigger managers and creators of closed-end funds. Them, BlackRock, Gabelli, Crumbine, they're real estate guys, right? And there are a lot of real estate closed-end funds, by the way. So they're all in the CEF Connect, and you can get lists by type, category, equity. There's even tax-free. Tax-frees that's the biggest and best thing if you need tax-free income that you can imagine. Saves you so much stress of dealing with individual municipal bonds. Man, that was just crazy times. Anyway, but but you've got, there's so many of them, and you can categorize them. You can list them in terms of yield, uh, percent of leverage. We're going to have to talk about leverage, right?
Yeah, why not?
Leverage, and 5 different ways you can measure them and look at them. Like I look at them, I don't buy anything in an income portfolio that's not paying at least 6%.
Mm-hmm.
And that's even when the market is high, So right now, I mean, the average yield on income closed-end funds is over 10% because we've just had a 5-time rise in the rate of interest. So interest rate sensitivity affects any debt security and hybrid securities, like a preferred stock, which is a hybrid debt and equity security. It's like the scales of justice. If interest rates go up, prices go down. If interest rates go down, prices go up. There's nothing you can do about it. It can't be controlled. You got to expect that. So that's why I'm not annoyed that I don't get the color red doesn't bother me in my statement.
So how do the closed-end funds, because obviously you mentioned mutual funds in the newer stuff, your exchange traded funds. How do the closed-end funds, how do they differ from these? Because obviously you said they're a much older vehicle.
Okay, we mentioned the one thing already. They're a pass-through trust. So think about it. If you're a pass-through trust, you can't reinvest your income to grow your market value. That's not allowed. Otherwise, you'd have to pay taxes. Now you're passing the tax liability on to your shareholders. So you can't expect these types of security to grow in market value. And they don't have the objective of growing. They have the objective of increasing their income, growing the income to their shareholders. That's their underlying modus operandi. That's why they're there. Okay, so that's a significant difference. Both mutual funds and ETFs have that growth incentive, just like the whole market does. So that's one big difference. The other big difference is they are closed-end funds. And that's not like a mutual fund that has closed its operation, that doesn't take on new owners. That's a limited number of shares, just like a common stock. When they go public, they have an IPO and they have a certain fixed number of shares. And they don't add to that. They add to that number in only 2 ways. And I'm not exactly certain if the drip method actually creates new shares or not. But they do occasionally send out rights offerings, so that's the way they can put out additional shares. They sell additional shares that way. But basically, it's a fixed number of shares. Neither mutual funds nor ETFs have a fixed number of shares. In fact, they manipulate the number of shares so that they always keep their price, their market price, equal to the net asset value of the securities they own. Okay. Unlike a stock. I mean, what is the intrinsic value of an equity? Is it the market price, or is it the book value? You know, they're never the same. Okay. So you have ETFs and mutual funds. Another distinction is mutual funds don't trade throughout the day. You can place your orders, but they execute tomorrow, the opening, right? Because they're manipulating the price at night, and then you buy it the next day or sell it the next day. So if you have one of these days where the market goes up, and we've had them 500 points in the morning. Oops, I'm sorry. It's my phone.
Couldn't hear it. It's all good.
Okay. Got a lot of nerve calling. Anyway. Where was, oh yes. We were talking about the differences between mutual funds and ETFs and closed-end
goes up
funds.
500 points in the morning.
Yeah, you get 500 point gain. I can go in and sell my mutual fund. You can sell your ETF, but you can't sell your mutual fund. So if it goes down 500 points in the afternoon and then continues on down, and you put the sell order in early, you're going to wind up selling at a loss the next morning, unless you really call your broker quick and say, "Hey, kill that order." You know, so that's that's another significant difference.
Now, you
Closed
mentioned
end.
with,
Go ahead.
so I was just going to say, you mentioned with the closed-end funds. So does you mentioned that you're not looking for the gain with the closed-end fund, it's more on the cash flow, but based on what you said, their price will fluctuate as well then. Is that correct?
Yeah, absolutely.
Okay. All right.
So you got trading opportunities all the time. And I took profits on 5 different closed-end funds today. Just because they're there, But so those are the main differences. Is the other difference is back to that net asset value concept. The closed-end fund is just like an equity. I was saying that the book value of a stock is this number, and you can divide that by the number of shares, and that would be the book value per share outstanding. But the market value is not going to be anywhere near that, particularly in the big ones in a high market. They're going to be at a huge premium to book value. Sometimes they're going to be at a discount. That's the way closed-end funds are also. Today, if the net asset value of most income closed, think about a bond, a treasury bill. Think about a treasury bill. A treasury bill is a promise of the government to pay back this amount of money to you. But when interest rates go up, the market value of your treasury bill still goes down, even though there's a 99.9% assurance that you're not going to lose any money on that thing if you hold it to the end. And it's pretty much the same way. I mean, even in 2022, you didn't hear about a whole lot of companies defaulting on their debt. Companies particularly companies that pay dividends, they don't ever want to default on their debt. So but the value is going down. So you could have a portfolio, like one of these closed-end fund managers could have a portfolio that's totally treasury bills. It could be down 25% in market value, where the net asset value could be down 25%. So one or two things is going to happen to the price of that thing. At a certain point, the price is going to go down because people who look at the net asset value. Oh my God, this is bad. And they want to sell it. Or I look at it and I say, oh my God, I can buy those treasuries inside this thing at a 25% discount. And I know that I'm not going to lose any money eventually because they're going to all mature. And if this guy's a good manager, he's got laddered maturities in there, right? Some are going to mature this year and next year. Well, even if he bought them, when they were 2% yield, when they mature, now he can invest them at a 5% yield. So now, click, he's going out there and he's buying treasure with the money that comes in. That's not income, it's principal. He's putting that principal back to work at 5%. So what we've seen in closed-end funds, particularly what they call variable rate bonds and short-term and intermediate-term bonds, we've seen them raising their distributions during this cycle of the market with the interest rates going up. Even though their prices are going down, they're raising their distribution rates because now they're getting more income on what they invest. And there are half a dozen of them that I can't say specific. I don't say specific stocks, but if you went to Closed End Fund Connect and you looked at variable rate security, variable rate closed end funds or short-term closed end funds, you would see that they have been raising their distributions this year. It's really very interesting. I think we've had a total of, I have a universe of 100 plus or minus closed-end funds, and there have been between 60 and 70 individual distribution increases this year alone versus only about 15 decreases. Because there's all different kinds of securities, like and some of them are variable rate depending on what they hold and some, but you figure that out after a while. You know what you can expect from each one, and that's my job pretty much, is to make sure people get into the types of situations that they don't have a problem, that their income keeps coming in. So it's fascinating, I think.
Yeah, I'm a little bit mind blown by it. Now here's I go to fees. What do fees look like on something like that? Because I
Fees
know
are
with
high.
mutual funds, they erode your profit massively with their fees.
Well, yes and no. If you were to, if, I don't own any mutual funds. You own a mutual fund. Do you ever see a bill for fees on your
No.
statement from the mutual fund?
No.
No, you don't. But and you never do in a closed-end fund either. They don't actually take that from you, but it's a fee that they have to pay before they can have that. They don't have any. The profits that they distribute to you are after they paid their fees. I'm talking about closed-end fund now. So the price. So if they're yielding 9%, the 9% is after fees. So
Okay.
if your Vanguard fund is yielding 3%, it's 3% after fees. Now our government, you want to talk about the government?
Oh, let's do it.
Let's do it. Okay. Our government says to the 401k people who give these great benefit plans to their employees, oh no, you can't use closed-end funds because their fees are higher than 2%. But you can use these Vanguard mutual funds and these other many different families of funds where their rates are only 0.5%. So I ask you, is 3% yield after 0.5% better than 10% yield after a 3% fee? I mean, really, which is more money? And the government says they base it on the cost. And I've had this question. I have a couple of Facebook groups that are focused on closed-end funds, And the question comes up all the time, well, what about the fees? What about the fees? Aren't the fees so high, so much higher than this or so much higher than that? I said, I've never paid a fee to a closed-end fund in my life, ever. It's the fee, the yields are the yields. They do have two other things though that are negatives. And we got plenty of time. So the one thing I mentioned before was leverage, right? And the other thing was return of capital. But first, do they use leverage in real estate investing?
Oh yeah, huge.
Right. Okay. So if you were to go out and buy, if you were to borrow money and you went out and bought 3 apartment complexes and the rents come in and they're going to be more than the interest you're paying on the loans, that's good business, right?
Absolutely.
Okay. So closed-end fund manager, I'm a closed-end fund manager and I'm running a portfolio of stocks or bonds or whatever. And I'm saying, okay, my business is owning securities that bring me back money, either dividends or interest or whatever, or even premiums on covered calls. I mean, there's everything you can think of, any strategies, everything you think of. You can find business development corporations, master limited partnerships. You can find all of them in CEF packages. It's really I think it's the easiest way to have a diverse interest in everything without the risk of an individual holding of one thing. So go back to this real estate thing, and you've got all that debt over here, you got all this income over here, and the income's more than the debt, so you're fine. The closed-end fund manager goes out and he borrows short-term money at whatever the going rate is, knowing that he can invest it at a higher yield. Okay, if he's in a sector-oriented thing like a municipal bond fund, he's going to have more trouble than if he's in a variable, multi-faceted type of income structure where he has preferred stocks and bonds and loans and mortgage, all that stuff. So he says, okay, if I borrow this money at 1.5%, like he could for so many years now, for several years, and I can invest it in stocks and have 3% or 4%, double the thing, and I can reinvest 5% of it and give the rest to my shareholders. So as interest rates rise, it tightens it up, but even though his cost is higher, his yield is going to be higher because now he can buy bonds at a higher yield. So he's not going to do this. He's a manager. He's you and me. I'm not going to go out and get another loan on my mortgage right now at 7.5%, am I?
No.
No way. I mean, I just got it down to 2.75. I'm not going to pay off that loan either. So it's the same thing. Leverage is not a 4-letter word. It's just not. It's what we'd all be riding to work on bicycles if we didn't have leverage. I mean, really. So that's one factor. Closed-end funds use leverage. ETFs, mutual funds do not. Stocks, companies, absolutely, they use leverage. How many companies do you think there are with zero debt on their balance sheet? I don't think you're going to find it.
Well,
So that's
just
go ahead.
I was just going to say, just the fact that they are a stock that you can invest in, that tells you that they're using leverage right there because they've effectively raised money through the public for the company.
Right. The equity. There's an equity interest and there's the debt.
Yes.
And the other thing about the debt, of course, if there is a bankruptcy, the debt holders get it first. Stocks are always riskier than bonds on the same company, and that's what do they call that? And when it's a sure thing, it's never changes. In economics, it's
certainty.
It is a certainty. And investing, the only certainty is uncertainty. So anyway, so that's the one thing. The leverage scares a lot of people. If you go out, I know you're going to go out tomorrow and buy my book. So when you do, and you give that to your financial advisor, he's going to say, oh, they use leverage. He's going to look at, you don't want to go there. They use leverage. Just replay this conversation for them. So people freak out because they call it leverage. They don't call it leverage in the business world. They just call it debt financing, and that's fine. It's exactly the same thing, except I'm not going out when I'm investing. I'm not going out and buying a building or building a building with the debt. I'm going out and buying securities that are going to pay me more than I'm paying in interest. It's that simple.
Jonathan and I have done a fair amount of work with NAV loans and the like, and it's just interesting hearing this type of NAV loan usage, because I mean it's basically the same. The difference with what we have done in the past is that when interest rates went out of whack, it became very difficult, because we're in Canada, for us to make those loans happen for the people that we're working with, because the sectors just didn't track at the same time. But now learning about closed-end funds, and that may be something that you and I should look at, JT.
Yeah.
Well, no, I mean, leverage is still always going to be important no matter what the market's doing. It's just a matter of who's utilizing it properly.
Exactly. And these guys, you got somebody who's a manager of a $1 billion fund or $800 million fund for a company like BlackRock or Nuveen. You got to figure he knows what he's doing.
Yeah.
You got to trust him. I know I have a lot of people, particularly in the Facebook groups, who are techie type people, and they're good people, but they analyze stuff. And you've heard the term analysis paralysis.
Yeah.
And there are people that just have to dig deep inside, and I've tried to avoid that. I really tried to avoid. I mean, I have very particular things that I insist on. Like, I'm not going to buy a closed-end fund that has less than 50. One of my quality checks is that thou must have more than 50 positions into this fund, or else it's not diversified enough for me. So I strictly follow that one. Sometimes for 7-figure portfolios, there may be an exception made, but if that's the only exception with that particular fund, everything else checks out, So that's the key element. I think leverage should not be as big as issue as people make it. There are people who say, why I think it was even came up in I have a Q&A in my book with my Facebook group people, and the book is a conversation between me and some prospective clients I met on a river cruise from Amsterdam years ago. And we come back, and then towards the end of the conversation with these guys, before they make their decision, I invite them to this Q&A I'm having with a Facebook group. And all the questions that haven't been answered get answered in this Q&A, and some of them are the ones we're dealing with right now. What about that leverage? What about this, and that? So it's really, these questions. So I'm more prepared than I might have been if I hadn't just read that book. But leverage is that's issue number one. In these groups, I'll have people who say, I only buy them if they have less than 30% leverage. I think the legal cap is 50%. Only once in the 20 or more years that I've used this method has the market gone down enough where the leverage has gotten above that point where the government says you can't pay distributions until your value rises to that above that 50% bogey. And it's been one or two issues, and they always make up the past distributions as soon as the market rises and they're back above that level. So it's never really been a problem, but people do like to focus on it. And then you look like you have a question coming, Jeff.
No, go ahead and finish. Go ahead and finish.
The other boogeyman, I guess you might call, is return of capital. Okay. part of the distributions of many funds, and particularly this past year, it's been a lot. Um, they pay back money that's not really income. It's literally it's return of capital, but the thing that's different. It's well, what's an annuity? Um, if you own an annuity and you start drawing from the annuity, you're not getting just income.
Yeah.
You're getting a
You're drawing
return
it
of
down.
capital. I mean, the objective is for the last payment to be made on the date of your death is a little bit of interest and the very last bit of your principal. That's what the actual aerial tables are all about, right? That's what it's going to be. It will probably never ever work out that way exactly. But if you were to every time you use that money to pay a bill, you're you're using part of your capital to pay that bill because they're returning capital. Same thing with a mortgage. If you sell your home and you take back a mortgage, wow, I made all this money. I got a mortgage. The guy's paying me 6%. And then you get 10 years into the mortgage and you're scratching your head. I'm not I'm not as wealthy as I was 10 years ago. Why is that? Well, dummy, you were using the mortgage payment to pay your bills, and the mortgage was more principal than interest. That's why. So it's the same thing with closed-end funds. They're giving back. If they're a bond fund, they may give back a piece of a matured bond. They may get principal back on a mortgage security they have. They may be selling covered calls against their equities. That's all income, but it comes back as return of capital. They may own another closed-end fund that pays back return of capital, and they're giving it to you. It's complicated. There are 3 or 4 different things that go into return of capital. Sometimes it is actually a return of capital, but how does that impact? It may impact the company. It may be negative for them if they do that long term, but how does it affect the investor? It doesn't affect the investor at all because every dollar of return of capital becomes a reduction in the cost basis of your security. So it's a dollar for dollar trade-off. You're getting it back, you can reinvest it, and it reduces your cost basis in the security that pays the return of capital. So for my money and in my investment world, I figure that I'm not invading that principle because I'm making that much more income for myself and up until May from all those other people than they're spending. So I'm not going to be invading that working capital. The only way that's going to be touched is if somebody's paying closer to his total income than he should be. And so it's exactly the same as an annuity or a mortgage security.
All right, so
You have to be aware of it. That's all.
I've got one question to wrap things up, and it's a little more generalized than how specific we've gotten. Having come through the 80s when interest rates were pretty darn high, especially
Yeah.
compared to today's rates. But we've seen a lot of fear in the market because of interest rates rising, because we've had historically low rates for a decade or more.
Right.
People have been used to 1% and 2%. 7% is not scary if you lived through the 80s. What do you find is the major differences in overall perception of the market between, because I mean the 80s were booming at 18, 19, 20%.
I know.
And now people are scared at 7.5.
I think it's just what they've grown up 12 years, like you said. And it's rare that I hear somebody say that, what you just said, which is very important. We've had historically low interest rates for 12 years.
Yeah.
That's a long time. I mean, that's what got me totally out of the stock market because it kept those prices up there. We didn't have, it was just craziness. And we're back right now, 5%. That's pretty much, I would guess that's probably about the old average.
Yeah.
When you say, I mean, I
Well,
remember
sorry.
I think that was about what my first mortgage might have been ever. was in that neighborhood, 5 or
But it was pretty,
6%,
yeah, it's pretty
right?
much where it was from, call it the mid 90s through to 2008. You were in that four and a
Yeah,
half to 6.5 range during that whole
yeah,
period. So
right. And
yeah,
that was normalcy. So we're really right where we should be. And the only reason that it's been so painful is because it just went up so fast. I mean, that was also historical, that we
Mhm.
went up from practically zero to over 5% in 18 months. I mean, that's scary in and of itself. That's why a lot of companies might have gotten, you can make a short-term loan of a 2-year or an 18-month loan, but when interest rates go up that fast, it might just overtake, it just might overtake it. It might overtake you. So
Mm.
particularly if you got a variable rate. Imagine if you had a variable rate mortgage recently. Holy mackerel. Jeez.
We've
So,
definitely spoken to some of those, haven't you, JT?
a few people. But
well,
just back to your comment about leverage, though, that's where, because rates were so inexpensive, the problem with inexpensive rates which we had is that people started, why would I not take it? It's free money,
back
until
exactly. I
it's
mean,
not. And now when you're over leveraged and it's not, that's where you're in trouble.
right, exactly. Exactly. So, yeah, so you have to keep it under control for sure. And on closed-end funds, there is a cap. There is a 50% cap. But remember, go all the way back to the Great Depression. Margin borrowing. There were no limits on margin borrowing in the stock market back in the 20s and the 30s. That's which is what happened. That's why people were throwing themselves out of windows, you know. So
That's
we have
crazy.
controls now that keep us from getting ourselves in that kind of trouble. So we'll see. Hopefully they'll work.
Oh, Steve, unfortunately, we're at the end of our hour here.
I can't believe that.
I love when that happens. This has been absolutely fascinating and eye-opening for me. Is there anything that you would like to leave our listeners with to, I don't know, either encourage them or inspire them to get to the next level?
I think they have to become. I think that they learn from their mistakes. I mean, they've always get so fascinated and focused on market value instead of income. It's almost like, give income a chance. I mean, you can't spend market value. Market value fuels the ego. Income fuels the yacht. And
Nice.
that's the tagline at the top of the book. Market value fuels the ego.
That's a great
Income
tagline.
fuels the yacht. And it just start thinking about
Fantastic.
putting it away, not just to try to find the next great hit or the winner. Put it away to build your income. Make that, like your dad told you when you opened your first savings account. Look how that interest builds on itself. Just think about the income.
That is fantastic, Steve. How do folks find you?
They can find me at theincomecoach.net,
Awesome.
theincomecoach.net. They can find me through the book. It's at Amazon, Retirement Money Secrets, and all my contact information is inside. Facebook groups, look up closed end fund Facebook groups and join them. You'll learn a lot. There's a lot of people to talk to there. Raise your questions, we'll answer them.
That's awesome. Well, thanks so much, Steve. JT, anything you want to say to wrap us up there?
Absolute pleasure speaking with you today, Steve. It was
I
a lot of fun. I learned a lot.
Good. I'm glad it was helpful. I enjoyed it very much myself. It was great. And my voice held out the whole time. That's good.
I love it when I have a full page of notes after an interview. So that's
Well,
that's
great.
great. Thank you so much, Steve. Thank you, JT. Thank you for listening. If you want to know more about what Jonathan and I do, you can certainly go to guidetothegrind.com. If you made it this far, please hit that like button, subscribe, share, comment. All those things really help get these messages out there. And Lord knows these are super important. Steve's created tons of millionaires, which is amazing to know that you can have that impact on people's lives just by sharing information. So thank you again, Steve. Thank you, Jonathan. Thank you for listening. Have a fantastic day, and we'll see you soon.